Alrighty, here we go. Here we go. All right, welcome to Bullish Bears Monday, August 3rd, 2026. Um, Afternoon stream here with a request for defining what some of these um, zones and different things are, topics and stuff. First of all, can I get a mic check? Either in voice or over in the main chat room. Voice and video, please. Can you see and hear me? I had some trouble with my microphone over last week, so just making sure it's working. Voice check.
You're good.
Thank you. Thank you. All right.
Marzini, will this be recorded?
Yes, it is being recorded, but it goes up on my channel. I don't have access to the Bullish Bears. I'll post the link and you're welcome to it. So we're going to talk about supply and demand, order blocks, liquidity run, liquidity zones, fair value gaps, the 180 reversal, measured moves, halfbacks, different things like that. And a lot of this is just simply terminology that you may hear people talk about. And maybe you're trying to figure out how do you trade it and different things like that. You'll find that a lot of times these things overlap, and that's a good thing when certain things overlap, because we have to remember that trading and the movement of the chart is for profit, but most of the targets and the entries and things like that are psychological numbers. For example, today's psychological number was 7,600. And I was calling that out this morning during Lucian stream. I said, we're going for 7,600 today. Because why? Because we were close to it. We were close to it. And there we are. We did hit it today and we ran a little bit more. So always remember that, excuse me, been munching on crackers and stuff here. Signet calls them roundies, and I think that's a cute but appropriate name here. 7,600, 7,500, 8,000. And I suppose in true tradition, in true Hobbit tradition, you could say halvesies, like 7,550 and 7,650. Halvesies obviously play a role in things as well. So remember that a lot of these numbers are purely psychological, and it's because trading is done by people and people trade in patterns. But understanding why a trade works is very important, so that you understand, what are they after, to see if that condition exists today. Because not every day does a condition exist. And we're going to look at a variety of different stuff. So let's go ahead and get started here. This is an open mic session. If you, pardon me, if you have any questions, you're welcome to jump in and ask. And if there's any issue with the stream, do let me know about that. Okay, let us start with supply and demand. Now over here is a 30-minute chart. And what I want you to see is this area right here. In fact, let me get the magnifier up. We can zoom in on that. Price came down, price went up. Price came down into that same area and rejected. Now, it didn't hold, obviously, we see that, but there is an initial example of demand. People are demanding the ES at this price range. They want it. Now, when we say the word supply, we're talking about a sell-off zone where people want to dump it. And let's just take a look at where that next zone might be. And it is right there. Now, let's take let's see, that is a supply 5, whatever. Anyway, it's red. So what is going on here? This means too high. People are not willing to pay it. People are not willing to pay that anymore. They say it's too high. They're not willing to continue buying it up. Now, that's one explanation. Another explanation can also be look left. Many, many, many times, how did you pull up that chart on the left? You mean how did I split it? Is that what you're asking, Rob? Rob's not here. Oh, he's talking about something else. To exhaust a trader. Never mind. Notice this is a chop zone here. Up and down, up and down, up and down, and up and down. This actually here is what we call an order block. I'll talk about that in a moment. It's hard for you guys to see, but just hang with me for a moment. Basically here, this is a supply saying people do not want to pay any more. They're not willing to buy it up. So what happens? It sells off. It went back up into it. It sold off. Now here, people are saying, I want it, I want it, I want it. Right there. Right there is, I want it. Right there was, I want it. So they bought it, it went up, came down. They bought it again, it went up, came down. This time, these people that wanted to go long were done with it. They made their play, they're done with it. And so we say it broke supply. Or, excuse me, broke demand. I got that backwards. That broke demand. So it crashes down through here, comes way back down here. Well, what happens? Look right here. It comes back into this demand area, and now there's a fight of, do we still want it for long or no? You know, remember, people went short here. Their stops are up here. They still want to continue to see this trend go short. So there's a little bit of a fight right there. Eventually, the shorters threw in the towel. Long takes over, comes back up into supply. Yeah, I keep getting these things. This is demand, this is supply. Went up here, people said, I'm not willing to pay it. Bam, down it comes again. Guess where it comes to? An order block, which I'm going to talk about. An order block is real simple, actually. Let's just go ahead and do that. An order block is actually incredibly simple. It's a fight zone. What I want you to see is this. Let me figure out again which tool is the marker here. Price. Well, I thought that was the marker. No, that's not the marker. Where's the marker? It's, I always lose this freaking thing. Give me a second. No, it's not emojis. Where is it? It's not here. Why isn't it here? Icons. Measure, I don't care about that. Rule, there it is. No. All right, anyway, we'll just go with, what am I looking for? What am I looking for? I'm looking for, screw it. Anyway, just go along with me here. Price is going up. right here, during the push up, there was a push back. All right, there was a push back. And when that, and there's my drawing tool up here. So it was going up, there was a pushback, and then there was a continuation. This pushback right here is an order block. That is a contested area. That's what an order block is, a contested area. So look what happened when price right here came back into this order block. Let's just go ahead and put a square rectangle here, right there. Okay. Price goes up, comes back into this contested order block area, and either, is it going to go up or is it going to go down? We don't know. We just know it's going to react here. We know it's going to react here. Now, some people would have gone long here. You would go long when it steps into here. Your stop would go down here, a couple ticks below the low of this. Some people say, well, do you count the wicks or do you count just the body? I count the bodies, but some people count the wicks. It doesn't really matter as long as you tune your strategy to know that. So you could have said that I've lost it again, damn it. There it is. Okay, I have to hit escape. You could say that it came back down into here. You would take the long up this way, and your stop would be down here somewhere, okay, in case it busts through. That's not a bad trade if you still have a bullish bias. But you kind of want to go with the bias on that. Let's look for another one. Quit drawing. Matter of fact, let's get rid of the drawings. It gets sloppy. Here's one right here. Let me zoom in on that. Right here is an order block. All right, see that? Price was coming up, went up, they pushed it back, the buyers pushed through it, price continued up. Now, obviously it stalled out, but look what happens right here. And so this defines the order block. Obviously I can't draw very well. So this defines the order block. Well, you see all this chop inside of it? All right, it's a contested area. So it was contested area. Definitely looks like we were rolling over, and you could have said, well, I could have taken a long here. Yes, you could have. However, the problem is, in this particular case, is you would have had a 20-point stop, which is not practical at all. And you say, well, the trend was bullish. Why didn't it continue going bullish? Well, again, it's a contested area. So there is an order block. Now let's go look at some other areas. No. Stop drawing. Here. Usually an order block, well, this is not really an order block. An order block is a resistance. Here's an order block. It's bullish going into it. You've got the pullback, and then it's bullish leaving it. That's an order block right there. All right, let's zoom in on that. Okay. Price is moving into it, pulls back, and then resumes. Now, let's explain the logic of what's going on with an order block. Some people, for some reason, may want to enter a trade short here. Other people may simply be closing their long position, and if enough people start closing a long position, what does that do? Well, they're selling, which causes price to come down. Then when they're done, the buyers continue. So there's two different reasons why an order block may form. And of course, it goes in both directions. You can have an order block, hang on, wrong keys. There we go. Let's see if we can find one going in the other, a good one in the other direction. Here, down, pull back, down. Now let's look, because we got this bullish momentum today. I don't know if this is going to, yeah, okay. So if I move over to the right, okay, well, this was a runaway day here, so it didn't react in that order block. Bullish, pullback, contest, break bullish. So we've got this zone right here. We see that price stuck a toe back into it. Try it again. Here, as we look to the right, contested zone, because here's that order block. But look here. Carry this order block all the way over. You can see we come down right here. We came right back into that contested area again. Now, these are not very nice and pretty looking order blocks necessarily, but the perfect shape seldom actually happens, right? The perfect shape seldom actually happens. That's just the way it is. You just kind of have to realize it for what it is, that it's a contested area. You could call this an order block here because we had a descending, we had a contested area, and then we continued the bearish trend. When we came back up into it, we contested, and again in this same area, and then moved on. Okay, so it doesn't tell us necessarily if it's a buy or a sell. It tells us it's a contested area. They make excellent targets. They make excellent targets, and some people will take a trade based on it. But again, notice as we come into this contested area, we're bullish. We come into the contested area, we take the chop, we go long somewhere in here, stop is down here below this low, and there's your move out of it. All right? Any questions about that? I lost my drawings, dadgummit. Anyway, my things. Any questions about what an order block is? I had to skip a little bit to the order block simply because of the supply and demand. So I want to go back to supply and demand a little bit more. And let's just move you over here. And I really want to see if I can get a bigger chart of it. What is this? Would you call this a significant low that was rejected? Right? This was a significant low that was rejected, so we'll call that a demand. Notice it didn't oscillate in it over here. This is very clear. Price was moving down here, hits this, and turns around and goes back up. Substantially. A substantial move out of that zone. Not just it went down here and then it wishy-washied around in here a little bit. No. It turned almost 100% around, right? As far as targets to the high. That is a demand area. Well, price moves and moves and moves and moves and moves, and here it is again. When it's in this demand zone, what this is telling us is the sellers are pushing, but the buyers are grabbing it faster than the sellers can push it, right? The buyers say, this price is good enough. I'll take it. And you say, well, why don't the buyers wait till it goes down here? Well, because everybody's going to jump in at different times. It's like going to an auction. If you've ever been to a real live auction and you've participated in one, and you say, well, they're auctioning off this widget, and I'll pay $5 for this widget, and everybody starts jumping in. $1, $2, $3, $4, $5. Oh, you're like, and it goes to $6, and you say you're out. I'm not paying more than $6. Well, lots of people in here, some people wanted it lower. Some people, though, but the point being is a lot of people FOMO in a way, if you want to call that, fear of missing out. And they say, I don't want to risk losing my chance to get the price that I want. I'd love for it to come down here to go long, but I'll take it here, because it could come down, turn right here and go back out, and I'll miss my trade entirely. So they jumped into the trade. Price then goes up, comes back down, and other people that still wanted it at this price jump in right here. And up it goes. And then down it comes again, and still more people are saying, I'll take it at that price. So this is a demand area. Okay? Now, let's take a look for a supply example. These are a little bit harder to find, but right here, let's just kind of look right here. Let's see, what do we see? Let's start here. Price creeps up, slam down, up, slam down, up, slam down. What is this telling me? This is telling me that people are not willing to pay this price. So somewhere around there, somewhere up in here. So we see 1, 2, 3 times it got slammed down. 4 times, 5 times, 6 times, 7 times. And then it broke the supply. Okay? So what we're looking for in this case here is, in the case of supply, we're saying, where is that point that price just can't seem to get through it? Every time it hits it, it gets smacked down. All right? And that is what supply is. It's an area where we say price gets smacked down. Now, if you were here back when Kevin was streaming, he would do it. He was a supply and demand trader, and he would do it on higher time frames. So let's just go to the 4-hour. And, oh, right there it is. Can't see it. All right, so if you're looking at it on the 4-hour, well, that's not a great example though, is it? It really didn't clarify. But right here, right there, you could say right there is a demand, because it's an area where price got hit and was violently rejected. Well, if we go back and look left, hang on, let me do this so it'll stop. Yeah, nothing really here on the left. Let's go to the right, and no. Okay. So, can we expect that if price ever comes way back down here, which is a long way down here, that it may react at this spot because that is a demand area? Yeah, I think that's a safe answer to give. Let's go back to the 30. I really don't like the look of that chart. Okay. So, the idea is too low, too high. If someone is getting out of a trade, say um, someone is long here. Well, maybe this is where their stop is. On the other hand, maybe you've got people that are short here, and when they hit this area, they're either closing their trades or the buyers decided this is a great place to pick it up. And so you end up having more buyers than sellers at this point. The same thing with the supply. So this looks like a demand. The same thing would be said with a supply area, where you would just simply say, nobody's willing to pay this price right here. Right there. See that wick? That wick right there. Some people would call that a supply. Jeremy would call that a supply. Kevin probably wouldn't. He might, because you've got it touching it here, you've got it touching it here, you've got it reacting here. Then we break supply, come back down into that supply, break the bottom side of it, oscillate back and forth. But so you can look for it on the higher time frames, you can look for it on the lower time frames. Does that help with supply and demand and order blocks? Do I need to I don't know if those explanations are sufficient or not. You guys tell me.
I'm just trying to learn how to draw them.
Okay. The way to draw them is to scrunch your chart up like this and look for the rejection zones right here. Okay? Right there. That's a rejection zone. This is a rejection zone. Right? Look at here, then look what happens over here. It does go long, but eventually it breaks it. Now, do we get back up to here, to 76? No, well, that's where we are today. And so we're testing this supply zone. So we had a demand zone here, and a supply zone here. We're testing that supply zone today. Now, in theory, somewhere in here we would take a short, looking for some kind of a target. We'll talk a little bit more about that in just a moment. All right. So how do you find it? Scrunch your chart up. And just start scanning left to right, right to left, back and forth. Where are the areas where it has been a problem? Here, here, here. Down here, 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 and here. And then you just kind of start fine-tuning it. It is fractal. Supply and demand is fractal in the most current day and previous day, but not over, in other words, if I go to a 1-minute chart and I look for, on this 1-minute chart, and I look for a supply way back here on Friday on the 1-minute chart, I doubt it. Okay, your time frame's too small for a 1-minute candle. A 1-minute candle kind of thing is not going to hold much weight. These patterns, while they are fractal, they're not going to hold much weight further back in time you go. But a 30-minute candle is different, right? In a way, you could just say a total candle count back, or something like that. You could say that the last 500 candles or something, maybe. I'm just making a number up. But at any rate, the further back we go in time, the less the supply and the demand have influence on the chart, simply because people have moved on. People have moved on, right? And accepted price at what it is. So, some people, like Kevin with supply and demand, he'll go back 2 or 3 weeks on the 4-hour or the 12-hour or whatever. And, that's his strategy. He knows how to trade it, and it works for him, and he's fine-tuned. The challenge that I had with Kevin's strategy, and it works for him, but it did not work for me, because we had a different tolerance of where our stops should go. And that's it. Kevin was willing to accept a larger stop than I was. Now, that's not right or wrong. It's the difference in who we are as far as our personalities and tolerances and stuff. I was not willing to accept that much of a stop. Kevin was, and so as a result of that, he could do supply and demand. I could not, because I kept getting stopped out all the time. Again, it's not a right or wrong. It just differences in our trading styles, right? Okay. Any other questions about that kind of thing? Like I say, supply and demand, scrunch it up. You can also go to the higher time frames, maybe like the 2-hour, and look for maybe like that and that. Ideally, you're looking for where it's been touched a couple times already. And you say, well, is this a supply? Because it did touch it here once, twice. Yeah, you could say that, but you also have to kind of measure the move. So I'm looking at, call that 7,100 to sit. Well, okay, it's 400 points there. Intraday trading, because I'm on the 2-hour chart here, but if we were on the, the 5-minute chart or the 15-minute chart, there probably could be some really good trades in there. Definitely some good trades in there. And because you would have 1, 2, 3, 4, 5, 6, 7 trade opportunities in there. Possibly that you could have traded that. But I like things. I'm not a supply and demand trader, so I'm going to go for the very, very clear and obvious, like this. I'm also going to look for it on the smaller time frame for my style of trading. So here I'm going to scrunch it up. I'm going to call that demand. And I'm going to call this supply. And that's it for me. Yeah, you can go smaller and smaller and smaller on that. Here you could say this maybe is a supply area. And we did hit it, and we did pull back, and then we breached it or broke the supply zone, and then we pulled back. Okay, fine, whatever. Now, this is, I don't really call this a demand zone. You could, somebody might. What I'm going to call it is a liquidity zone. Liquidity. What I mean by liquidity is, just see all this chop, 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 choppity, 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 chop. What that means is it is an area that both sides are trying to take positions and they keep getting stopped out, right? So what do we think is going to happen? What do we think is going to happen when a trade goes long over here? if it's going short, let me back up. Here we have a chop zone. And we're going to call this chop zone a liquidity zone, because there's just tons and tons and tons of contracts being traded right there. There's just tons. I mean, here you've got, here you've got some contracts that went long. And most of these people are just sitting in the trade, waiting for it to, to do its thing. They're not buy, sell, buy, sell, buy, sell, buy, sell. No, they're just in their trade. Here is a lot of buy, sell, buy, sell, buy, sell, buy, sell, and we call that a liquidity zone. Now, what does that mean? It means it's a magnet. It means it is a magnet that price loves to come back to it because everybody liked this price. And so we look at it here and here. We can see we came back to it here, 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 and here. Okay? And that's called a liquidity zone. It's a place where everybody fights. Everybody likes the price. Everybody wants to get to the price. So if you're long, you want to get here. If you're short, you want to get there. It's your target, because it's a price that everybody is really taking positions. And again, this is where a lot of people have gotten stopped out over and over and over and over. Everybody's either trying to go long and short here, long and short, and they keep getting tore up. These are the zones where you lose your ass. Never, never initiate a trade in a liquidity zone, a chop zone, because you don't actually know where it's going to go. Here it went up. Here it went down. Here it went up. Here it went up. We don't know which side of the zone is it going to break. So it would be my advice to you to use it as a target, and regardless of your strategy, whether it's Bollinger Band, supply and demand, measured move, whatever, I would tell you to never initiate a trade in this zone, because it is a chop fest, right? That is a liquidity zone, right? Questions about liquidity zones? Let's go back and look at some of them in the past. This is bigger, but look. Up, down, up, down, up, down, up, down, up, down. Chop, 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 chop. Right here. Choppity chop. Now, that's not to say that here we see, let's look at this price, 75.21 to 75.68. If you're on a lower time frame, there's some fantastic trading that you may see in here. If I went down to the 1 minute chart or something like that, I may see it. But I must be incredibly mindful that if we're looking for a breakout of this zone, I should have this chart mapped, sort of like that. And I should know that I am in a high risk reversal area. Now, if I come down to the 1 minute chart, where are we? Wednesday the 26th, because this will probably move. Okay. Perfect. Absolutely perfect setup. Hang on. Give me a second. I want you to notice this low. Okay, everybody see that? You see this low right here? What happened following this point in time? We went bullish. So there are people going long. Where are their stops? Just below, right? Just below. What happened right here? It ran those stops. That candle came down here and hit all these stops right here, triggered it, took over their contracts, and went long. So essentially what they're doing is somebody else took over the long trade from these people. Okay? This is a liquidity run. You ran for somebody's stops. Here, these people are going short. Where are their stops? Right just above it. Look what happened. We ran up here, triggered all their stops, took over their shorts, and came back down. Took over their stops to go back long. Now you say, well, how come it didn't reverse here? Well, it did. Ultimately, it did reverse here, but what this tells us is there was a lot of money being spent to try and keep it going up and up and up. And you have to remember that all trading is a matter of exhaustion. Who throws in the towel first? So these people were trying to really punch this trade to go north. The seller stepped in, kept pushing against them, until finally the buyers gave up, waited for another chance to get in, dogpiled all the sellers here to go long again. All right. So again, you see what happens. We're in this chop zone and we see what happens. Toe in, jump out. Foot in, jump out, whatever. But if you come to the smaller time frame, like here on the 1 minute, perfect trade right here, ran the stops all the way to the other side for 40 points. Outstandingly good trade if you were in the trade the entire time. So how would you trade this? Well, you'd look here. You'd set your entry just a little bit above it. You're long. So price would come down. You would go long here. Yes, you take a little bit of heat. Your stop, you have to decide where you want your stop to go. Your stop actually can be set right over here. Let me hit that line. That's a possible. Oops, nope, wrong place. There. And actually, this line's in the wrong place by a tick. There it is. Okay, close enough. So we see this. This runs their stops. That's a liquidity run. We go long. We have to set our stop down here somewhere. And voila, we're now looking to take out here. It does hit here and it blows on past it a little bit. Okay? So, how predictable is a liquidity run? You just have to look at the chart and say, what is it doing? Were there liquidity runs in this chart going on prior to this? Absolutely. Let's take a look at, let me amplify this. No. That low and this low are the same. But this low clearly took out this low, which took out that low. Okay. You say, well, how do you know if there's liquidity down there? All right, good question. Why is this an entry? Could this be an entry? Yes, it can. You could have gone long here for this trade here. And how would you do that? Well, let's bring in the measured move. We have this massive ass move here, right? And then we start the sideways chop. Okay? Chop follows big moves. Why? Not always, but when you have a big move like this, the institutions spent a lot of money to make this go down, right? Well, at some point, they say we've spent our budget for the day. So when they've spent their budget for the day, that's where it was right there. And that's why the stock or the ticker, the futures contracts price stopped going down, because that was the amount of money that they had to push this down. Then they said, we're done with our move. And then maybe they started selling some, or buying some to take profit. And then you got some retail, and you got some this, and you got some of that going on here. But the point being is that the bulk of the budget, 90% of the budget, was spent right here. Now they're out of money. And so now you've got the smaller traders, retail traders, other institution algos, stuff like that, are trading here. And this is why consolidation follows. Big moves. Understand what happened in the big move. Now, so money was spent to make this happen. And now they're done with the money. They're done with the trade. So all this just now is resting, trying to decide what are we going to do next. And as you can see, it stayed there from 10 a.m. Well, it stayed there practically for 24 hours. Okay, and it rested for 24 hours. Now, granted, that's 20, 30 points wide. There's plenty of trades inside of that, but that's the point, is that this is why, when we have FOMC day and CPI day and PPI day and, whatever, that's why these patterns happen a lot of times. All right. Now, yeah, sorry about all the background noise there. It's my motion detectors in the driveway. All right, where was I? Okay. So why might I have, oh yes, the measured move. That's where I lost my train of thought there. So what I want to do, I'm going to invoke a fib tool here to here. Why am I choosing that? Well, let's say we're right in here during time. If I look left, that's the most significant high, that's the most significant low. Okay? Then price chops. Liquidity grab right here, I think. Maybe, I don't know. We're going to say it is. I can't 100% tell. But we're going to say that was a liquidity grab. Now, this is where the magic starts to happen. Actually, it's more clear on the top side, so let's do that. Here is right here is the top of the box that we drew back over here on the left. Okay, so the box went from here and then it went down and grabbed the bottom. This candle punched. and did a liquidity grab outside of the top of the box, right? There's a liquidity grab. No, I don't want that. I want... So it grabbed liquidity. Now, this is hard to see because it's red on red, but this number right here is what we call the 111. It is 1.118. Technically, it's 1.118. Now, Signet often refers to it simply as the 111. Technically, it should be the 112, if you're rounding, but he calls it the 111. So everybody calls it the 111. Where does that number come from? It comes from dividing 236 by half. Where's 236 come from? It's a Fibonacci number. And we can talk about Fibonacci's if y'all want to later on. This is a very common reversal zone. And the basic theory goes, if we can get up into here and stay up here, we move up. If we don't, we fall back. So what happened here? We punched, did a liquidity grab, and failed. All right? And then because these people were long, coming into this, people were short. These people took it over and took over their shorts for this huge run all the way back down. All right. So what we see then is this 111 here and the 1236 there is the most common reversal zone if it's going to reverse. But if it does not reverse, where does it go? 50%. Right there. And if it stays above 50%, then it goes to the 786. Sometimes it'll make it to the 2. But more often than not, the exhaustion point is the 786. The exhaustion at the 786 is by far the more common reversal exhaustion point. Okay? So let me explain this measured move to you again here. Actually, let me clear some drawings, and I'm just simply going to go over here to a black space. Okay. Now, we note our box goes from here to here. That's where we measured the highest high to the lowest low. All right. This zone from here down is the same height as the measured move. This height here above is the same height as the measured move. So that is this line and this line. And price we see has been just chop, 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 chop. Okay? When price breaches, one side or the other, doesn't matter. Initially, it's a liquidity grab. They're grabbing to try and take over these other people's contracts so that they can go short, let's say. So I breached the high to go short. Had I breached the low, I'd be looking to go long. Why? Remember, we're taking over these people's contracts. Okay? So you can say that you would go that if price breaches the 0 line or the 1 line or whatever outside of the box, that we would initiate a short with our stop at the 236. There's my stop. With the idea that these people are taking over their trade. Somewhere in here, people were short coming into this, and it moved in here. Price breach, take over these people's short to carry it down to the other side. Now that is the idea. Does it work all the time? Absolutely not. And again, we have to take it in context with the overall chart. In other words, if had been, if price had been bullish coming into this, and I see a breach here thinking I'm supposed to go short, is that trading with the trend? No, it is not. It is not trading with the trend. Would I take the reverse trade here? Maybe. Tight stop, very tight stop. Would I go full size with no, small size. Because if I'm going to go short here, I'm going against the trend. Okay? But price here, 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 breach. Might I take it long there? Very possibly. I might take a long trade there because that's a continuation of the trend. We ran liquidity here to take over the long trades of these people over here to go long. But again, you just have to, you kind of have to look at it in the context of the overall trade, what's going on. Any questions about the idea of the measured move? So the 111 and the 1236, all the way up, essentially the first 25%, that is your reversal zone or your contested zone. If you can get up into here and stay up into here, you're probably going to the 50. If you can get above the 50, you're going to the 786. This now is where exhaustion really starts to take place, and this is usually where we start to see the fall off. But it can run on to 2 and even beyond. Like today, many measured moves today just kept going up. Even though it hit 200%, it still just kept going up, and that happens. All right. Let's see. That was the measured move. So there's supply and demand. There's order blocks. What's an order block? Here's an order block. That's an order block. That's an order block. If we look at these two circles and we go to the 5-minute, see? It's much cleaner on the 5-minute, isn't it? Doesn't have a lot of chop in it. It's just you very clearly see that order block now because you've got 1 or 2 red bars here summarizing it. 15-minute. It's even cleaner looking. Price is going up, contested, continued going up. Contested, continued going up. It's not what I want. And we have not come back into it. So order block, a simple pullback, that's all it is. I was going to talk about I saw a 180 in here also. I wanted to mention that one. That was on the 30. Y'all jump in anytime you want to if you have questions. Where was that 180? Oh, actually, okay, there's the 180. First of all right, let me come back to this in a minute. All right. Notice this green candle here. It opened here. A little pullback down to here. Upside here. Closed here. I want you to notice that the close is in the top 25% of that candle. If I can do this. All right, whatever. Freehand with a mouse. I'm no good at it. So it's in the top 25%. Okay? Notice the candle immediately after it. It opened here, went up here, came down here, closed here. Notice in this case, it's in the bottom 25%. That is called a 180. And it's a reversal candle pattern. Price is going up, slam down. We expect it to continue down. Or the vice versa. Or vice versa. Okay. Question about any of that? Notice right here. No, I don't like that. Let's do this one. I like this one 100 times better. This is textbook. Textbook right here. Price is going up. And then we have a perfect doji. Well, not perfect because it didn't end exactly in the middle, but the point is that the open and the close are on the same number. See that cross right there? The open and the close right there on the same number. And then this candle rolled over. And eventually, this candle's low becomes the target. That is called a rally base drop. All right? So there's rally base drop. There's drop base rally, which is the exact opposite. And of course, there's rally base rally and drop base drop, but we're not interested in those so much. The way you trade this candle here, when it breaks the low of the doji, right here, you'd go short. Your stop is up here at the top of the doji. Your target, the low of this candle, of the candle right before the doji. All right, that one's absolutely textbook perfect. Didn't expect to find that. Well, what if it's not a perfect doji? What if it's you know, what if it looks more like this? Drop. Now, is this a proper base? Technically, it is not a proper base. Why? This wick should go deeper than this wick. it should show a reversal. In other words, they grabbed liquidity grab. You should see it go down more, grab liquidity to take over the trade. So that's not perfect. It did work out, as we can see. It did work out, but as far as a teaching tool, not a perfect example as compared to the other one. Here. Took liquidity, rolled over, went down. Questions? All right. Measured moves, supply and demand, liquidity grab, liquidity zone. Trying to think, is there anything else? This is your chance to speak up. Speak up. Tell me what you're thinking. Okay. If anybody's got anything, that's fine. If not, I'm going to wind it down. Okay. I'm going to go ahead and wind this down. I think I've hit all the topics. Let me double check real quick. Supply and demand, liquidity, order blocks, and so on. Now, the next question, of course, is, does it matter which ticker you're using? SPY, QQQ, IWM, and all that kind of stuff? No, not at all. It's the same. What about time frame? Does it matter? No. But certain things don't hold as much weight further back in time, like supply and demand that's 2 weeks old is not going to have any relevance when you're looking at a 1 minute chart, right? That's just too far back to really make a successful trade. So just be aware of that kind of stuff there. All right. Unless anybody's got anything else, I'm going to wind it down. I hope that helped answer some questions. I will upload it to my YouTube channel and post the link over in Maine for anybody that wants to watch it again. So, hope it helped, guys. We'll talk to you later. Bye.
Thanks.
Yeah. Glad to help. Yep.